Hey, it's Dr. Rob again, and this time we're going to be talking about accounting for income tax. What I'm going to try to do in this talk is give you a feeling for why and how we account for income tax the way that we do. And I'll use a few examples to illustrate these issues. Okay, so let's start by talking about why this is even an issue. Why do we need to account for income tax? Surely income tax expense is the same as the income tax that you're paying. Well, it's not. We know that accounting profit is different than tax profit. And we know that's the case because, well, financial accounting report rules are different than tax accounting rules. And they're different for one clear reason. The tax authorities want to have numbers that people can't muck around with. So they value numbers that are reliable, that aren't changed by changing assumptions. So in particular, they're less keen on using estimates, such as estimated expenses, for example, long service leave, warranty repairs, doubtful debts. The financial accounting rules, however, tolerate estimates in a lot more situations, because for financial reporting, we trade off reliability and relevance. So what's this mean for accounting? Well, look, it means that if we compare accounting profit and tax profit, we're going to find some differences because the rules are different. So there's three possible situations we could have. Firstly, there's going to be items, and to be honest, a whole bunch of items that appear in both accounting profit and tax profit at the same time. So that's okay, we don't need to worry about those. Then we're going to have some other items that appear in accounting profit and in tax profit, but they appear at different times. For example, we might depreciate an asset over 5 years for accounting, but the tax law forces us to depreciate over 10 years or allows us to depreciate it over 2. That means overall depreciation is going to be the same, but the speed at which an asset depreciates will be different for accounting and for tax. And lastly, there are things that are going to appear in one but not the other. So we might have something that appears in accounting profit but not in tax profit, or something that appears in tax profit but not accounting profit. And the best example of these are tax incentives, imaginary expenses essentially. If you think about making an investment in a movie, governments from time to time give incentives for movie investments. So they basically say something like, if you invest $1 in a movie, we will let you claim $1.50 expense on your tax return. In other words, they're allowing you to create a 50 cents imaginary expense. Obviously, that imaginary expense, although it appears on your tax return, it will never appear in your accounting profit calculation. All right, so what do we know? We know that we've got these differences between accounting profit and tax profit. And what's going to happen is sometimes the tax profits will force you to report a higher profit now than the accounting rules will let you. For example, if we're forced to depreciate an asset more slowly for tax reasons, but sometimes they will allow you to expense things more quickly for tax reasons. Sometimes governments will say, if you purchase an asset less than $1,000, we'll allow you to treat it as an expense straight away, even though for accounting you might sensibly depreciate it over a number of years. Why would you like that? Well, money has a time value. If I expense something for tax straight away, it reduces my tax bill now. It reduces the amount of tax that I'm paying. So let's work, of course it will catch up eventually. So let's work with this second example where you're allowed to expense something more quickly for tax than for accounting. And as we work through this, hopefully you'll get a feeling for the intuition. And if the intuition works for you here, then it's easy to extend it to other examples. So basically I'm going to talk about a simple situation where we're depreciating an asset. The asset costs $100. Let's assume the corporate tax rate is 30%. The only difference between accounting and tax is the depreciation. So everything else is the same. There's a whole bunch of other revenues and expenses. For the purpose of this example, we'll assume they're the same. So let's assume that all those different items, the ones that are the same, in each of 5 years are 100, 200, 400, 300, 500. So to work out your profit each year, you'll take, for example, in year 1, you'll take the 100 other stuff, you'll take off the depreciation, and that'll give you your profit. So if you're depreciating the asset at 20% per year for 5 years, the depreciation for accounting in the first year will be 20, so your accounting profit will be 100 minus 20 is 80. But if tax allows you to depreciate the asset at 50% per year, then your tax depreciation in the first year is going to be 50. So your tax profit's going to be 100 minus 50 equals 50. Okay, so this is going to be an example where you depreciate the asset more quickly for tax purposes than you do for accounting purposes. Okay, so let's go into the example. Now, what I'm going to do is I'm going to give you the incentives here using a profit approach. This is not the way that IAS 12 actually talks about accounting for income taxes, but this will give you the intuition, and then when I move on to the way IAS 12 actually talks about it, the intuition should still be there for you. Okay, so here's the simple situation that I've just described. We've got an asset, it's got, there's other stuff, so there's all those other items that are the same between accounting and tax, and here they are up in the first row, 100, 200, 400. The depreciation between accounting and tax is basically going to be, the depreciation, my apologies. The depreciation is going to be the same over the life of the asset, so it's going to be 100 in each of accounting and tax, but you'll notice that for accounting it's going out slowly, 20, 20, 20, 20, blah, 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 whereas for tax it's depreciating more quickly. Now let's have a look at what this means for accounting profit. The profit is going to be 80 in the first year, but if you look at tax depreciation being different, the tax profit is going to be different than the accounting profit. Same in the second year. The 180 is your accounting profit because that's 200 minus 20, but your tax profit is 150. It's 200 minus 50. Then in years 3, 4 and 5 the situation sort of reverses because you're still taking off accounting depreciation to come up with accounting profit, but you've already finished depreciating the asset for tax because the full 100 has already been depreciated out. Okay, so for the last few years you're going to have your tax profit bigger than your accounting profit, even though in the early years it was the other way around. But what you can see is that the total is still the same, right? So your profit over those 5 years is still $1,400. It's just that when you report it for accounting is different than when you report it for tax. So in the early years, you're reporting more for accounting than for tax. In the late years, you're reporting less for accounting than you are for tax. But in the long run, the amount is still the same. So it's pretty clear that accounting profit causes tax. All of that $1,400 accounting profit gets taxed sooner or later. So why are you depreciating more quickly for tax? Well, if you're allowed to, you can avoid some tax in the early years. Basically what's happening in the early years is you're avoiding tax, but as you will see from that last slide, eventually it catches up with you. Okay, so let's talk about the amount of tax that you actually pay. If you calculate the tax paid in any year, well, if your profit in the first year, tax profit, what's tax profit? Tax profit is profit calculated according to tax rules, according to the law. So your tax profit in the first year is 50, you multiply that by 30%, the corporate tax rate, that gives you a $15 tax bill in that year. Okay, in the second year, 150, and so the amount of tax you're paying is 45, etc. So what you're seeing is that all of the 1,400 gets taxed sooner or later. In other words, all of the 1,400 causes tax. It's just you are able to manage when that tax gets paid. So let's think about how much tax is caused in each year. Remember, all of this 1,400 is going to appear on your tax return as well as appearing in your accounting profit calculation on your income statement. So all of this 1,400 is going to cause tax. It's just the amount you pay is going to be different than the amount you cause. If all of that 1,400 causes tax, then all of this 80 in year one will eventually be taxed at a 30% rate. It might not be taxed this year, but it will be taxed eventually. So if we have a look at the tax that we're causing, we are in total causing $420 worth of tax. And in total we're paying $420 worth of tax. But in the first year, our accounting profit is 80, we're causing tax of 24. But on our tax return, we get to say to the tax office, our tax profit is 50. And so we only pay 15. Similar thing happens in year 2, but once we get to year 3, the situation reverses. Our accounting profit includes some depreciation, so our accounting profit's 380. In other words, eventually, sooner or later, we're going to pay $114 worth of tax on that. But over here, under the tax rules, we finished our depreciation. So our tax profit is now 400, and so we end up paying 120. Okay, so in the last few years, we're basically paying more than we cause, but in the first few years, we're paying less than we cause. But in the long run, of course, the two numbers are the same. Okay, since all of the 1400 of profit causes tax, the reason you managed to delay reporting some of that for tax purposes in the first year is because tax rules allowed you to do that. So you haven't really avoided tax. All you've really done is delayed it. If accounting is telling you the truth, then your real profit in the first year is 80. So it's going to cause tax of 24. But the tax system allows you to report a profit of 50, purely and entirely legally, and so you pay 15. But the nature of the depreciation, the fact that it's still got to add up to 100, means it's going to catch up with you sooner or later. Okay, so when we talk about accounting profit causing tax, accounting profit is causing what? It's causing a tax expense. So let's actually put some account names in. Oh, by the way, income tax expense usually has a debit balance because it's an expense. Sometimes it might be credit. Then it has the weird name of income tax income. Okay, so we've put some account names in. Look, the numbers here are all the same as they were before. And all I've done is I've said we've got an income tax expense that is based on the profit calculation, and we've got a current tax liability which is based on our tax calculation. Okay, so this all makes some sort of sense. It's consistent with the standard so far. So let's have a look at the journal entries that we would do. Now, the thing you need to remember about accounting for income tax is there are basically two types of journal entries. There's one for the current tax and one for the deferred components. The fact that you're deferring some tax and later it's catching up, or in other circumstances, not this example, the fact that you're prepaying tax and then that catches up. So if you go back and have a look at the example we just had a look at, how much tax will we be paying in the first year? We were going to pay 15. So if you like, of the 24 tax we've caused, 15 is our current tax liability. So let's first do a journal entry for our current tax. The amount of tax that we're currently paying is 15. So the journal entry that we do for that is debit income tax expense, credit current tax liability. Now let's look at the deferred tax. Go back a slide. How much have we put off? Well, look, we've caused 24, but we're paying 15. So we have delayed tax of 9. That's the tax on the $30 difference between this and this, which is due to a $30 difference between the depreciations. Okay, so we've delayed tax of 9. So let's do the journal entry for that. Let's recognize that we've got a deferred tax liability. We're going to pay that sometime in future. And that's also giving us income tax expense. So what's our total income tax expense? Well, it agrees with what we had on that previous slide. It's 24. Right? Our income tax expense is 24. It's just that some of it is being paid now, some of it is deferred for later. Okay, so the current tax entries for those 5 years are going to be based on the current tax liability you've calculated. So here are the numbers, and that's the journal entry that you'll be doing. The deferred tax entries for each of those years, will be what? Well, in the first year, your income tax expense was 24, you're paying 15, so you've delayed 9. Second year, same thing. You were causing 54, paying 45, you've delayed 9. But then once you get to year 3, it all starts reversing. So in year 3, you're causing 114, you're paying 120, so why are you paying extra? Because you're paying off some of that deferred tax liability. It's catching up with you. So in the first few years, the DTL is going to increase from 0 to 9 to 18, and then the deferred tax liability is going to decrease in each of the next years from 18 to 12 to 6 to 0. Okay? So this is essentially a temporary difference. It builds up, it goes from 0 to 9 to 18, and it reverses from 18 to 12 to 6 to 0. So it's a temporary difference. It builds up, then it goes away. Now, the example I've given you so far it gives you the intuition, and it's reasonably right, but it's not 100% right. If you actually think why it's not right, it's got to do with the fact that the income statement doesn't capture all your changes in wealth. Some changes in wealth go directly to equity. So if we look at this from a balance sheet perspective, we're going to get the same result, so the intuition still works, but it'll help you work out situations that are a little bit different. So let's now have a look at this situation from a balance sheet approach. The intuition that you've got so far is still going to make sense, hopefully. Okay, now if we're looking at this from a balance sheet approach, let's look at the various reports that we've got to consider. What I've done is I've color-coded things here so that anything accounting is nice, therefore it's blue. Anything that's tax-related is evil, therefore it's red. Okay, so for accounting, our measure of performance is our accounting profit is calculated on the statement of profit or loss and other comprehensive income. And in relation to the example we've already talked about, that's the accounting depreciation calculation. The implication of this for the asset appears on the balance sheet. So on our accounting balance sheet, we have a carrying amount for the asset, and after it's depreciated 1 year by 20, it's got a carrying amount of 80. After 2 years, it's down to 60. Eventually, it comes down to 0. Now, what about tax performance? Well, tax performance is reported on the income tax return, and that includes our depreciation calculated using tax rules. So you'll remember that that's 50 and 50 in the first 2 years, and then nothing because it's finished. Now, not all tax authorities require us to submit a balance sheet. However, what you need to do under IAS 12 is think about what a balance sheet would look like if one were prepared according to tax recognition rules. So on a tax-based balance sheet, you'd also have a carrying amount, but it would be different than the accounting carrying amount. If you depreciate the asset for 50 in the first year, the accumulated depreciation is 50, the asset's 100, so your carrying amount's 50. After year 2, there's another 50 of depreciation, so your asset's 100, your accumulated depreciation is 100, so your carrying amount is 0. So they're both going to the same place. They're both going to 0. Now they're both going to end up 0 and 0. They're just getting there at different speeds. Now notice I've indicated that carrying amount on the tax-based balance sheet is a wrong name. What IAS 12 actually calls it is the tax base. So what is tax base? Tax base is just the carrying amount of an asset or liability calculated using tax rules, not accounting rules. Now, be very careful with that word, because that's the way IAS 12 and accountants use it. I mean the phrase, tax base. Economists use this phrase differently. A tax base for an economist is something that can be taxed. So income, wealth, number of employees, entire wage bill, the width of your house in 17th century Amsterdam, all of these things were things that could be taxed. Okay, so let's have a look at the story we've already been looking at, but this time from a balance sheet perspective. So what I've done here is I've said, let's look at this from a balance sheet perspective. What I've done up top, what are our accounting numbers? Our accounting depreciation is 20 each year. Our carrying amount goes down from 100 to 80 to 60, all the way down to 0. For tax, this is just summarizing that slide before. The depreciation is 50 in each of the first 2 years, so our tax base goes from 100 to 50 to 0, and then it stays at 0. Now, one thing to understand is that the balance sheet tells you about the future. If you think about what an asset is future economic benefits. So an asset is something that is going to be expensed in future. It's as it gives you those benefits. Now, it might give you those benefits through use, or it might give you those benefits through sale. So even land has future economic benefits. When it sells, though, those benefits will appear as the expense part of the gain on sale calculation. So really, what we know when we look at a carrying amount is that a carrying amount is telling us something about the future depreciation or the future expensing of that asset. In this case, it's depreciation. If it was prepaid insurance, it would be future expensing. It's still the same principle. Well, if we see that in our accounting records, we're also going to see that in our tax records. The tax base tells us about the future expenses on our tax return. So the carrying amount and the tax base are there because of what's happened in the past. When we see a difference between them, we see there's a temporary difference, but it's telling us about how that temporary difference is going to reverse in future. Right? 80 of it has to reverse in future income calculations for accounting. 50 of it has to reverse in future income or profit calculations for tax. So essentially, if we're looking at year one, the carrying amount of the asset in year one basically says, look, future profit is going to be hit with a reduction of 80. Future accounting profit is going to include a depreciation of 80 in future years. Similarly for tax, if the tax base is 50, that tells us that future tax depreciation that goes into future tax profit calculations will be 50. So the carrying amount and the tax base are summarizing future expenses. And so the difference between the carrying amount and the tax base is summarizing the difference between future accounting profit and future tax profit. Okay, now we go forward to year two, the same applies. So carrying amount in year two is 60. That's telling us the future accounting depreciation is also going to be 60 over 3 years. For tax, the tax base is 0. That's telling us the future depreciation according to tax rules is going to be 0. So again, the carrying amount is telling us about the future accounting expense, the impact on accounting profit. The tax base is telling us about the future impact on tax profit. Okay, now notice what we've got here. We still have the standard depreciation example we've been working with. So if you look at year two, and in fact if you look at year one as well, we've got the same effect. The carrying amount of an asset, remember it's an asset we're depreciating, the carrying amount of an asset is bigger than the tax base. Now you know from what I've told you about the income statements, the profit calculations, that we've been deferring tax here. So having a carrying amount bigger than a tax base for an asset tells us that future accounting profit will be less than future tax profit, because future accounting profit has got more depreciation to go than there is depreciation to go under tax rules in the tax profit calculation. So whenever you see an asset with a carrying amount greater than its tax base, you know there's a deferred tax liability. This is the intuition that the depreciation example is trying to give you. And if you understand this, you can logically work out what might happen in other circumstances. So basically, where you've got an asset, carrying amount is bigger than tax base, you've got a deferred tax liability. Now, remember that depreciation example, because if you know that, you can draw up a little table. The depreciation example is the first line in this table. Now notice what I've done is I've marked a few of these things in red. And this is to help you remember. You're only allowed to flip 2 of the red things at once. So if you move from line 1 to line 2, what have we flipped? We flipped the inequality, and that means if it's the other way around, we're going to have a deferred tax asset. Another presentation will show you examples of these. What about if we go from the first line to the third line? What have we flipped? We've flipped the liability. We haven't flipped the inequality, so we have to flip the fact that DTL now becomes DTA. If we go from let's go from this line to this line. What have we flipped? Liability is still the same. The inequality has flipped around. It was greater than, now it's less than. So the DTA must flip to DTL. So if you remember the basic depreciation example, you can work out all other circumstances just by constructing this table. Okay, so I said that the reason I was looking at the balance sheet approach was basically because the profit approach doesn't always give you the right answer. Well, why is that the case? The profit approach gives you the intuition. So the intuition works, and it's a good way of remembering the intuition. But the reason it doesn't always give you the right approach is because some wealth changes do not get reflected in profit. Now you already know this. When you've got qualifying cash flow hedges, you've got some revaluations, go directly to owner's equity through other comprehensive income. They don't go through the profit part. Okay, so let's have a look at a revaluation and have a look at why this is an issue. Now, what happens if we revalue an asset upwards? Well, you know that you debit asset, you credit revaluation surplus. And, I'm simplifying away the issue of closing off the accumulated depreciation. Okay, that's the accounting rule. Can we revalue an asset for tax purposes? I think it's pretty obvious what the answer is going to be. The answer is going to be no. And why not? Well, let's assume I buy a pencil for 50 cents, or whatever a pencil costs. If I could do that for tax, I could buy a pencil for 50 cents. I could revalue it up to $3 million, and then use that to calculate my tax depreciation for the next few years. See why it doesn't work? See why the tax rules do not like estimates? So you don't get to revalue things for tax purposes. So let's work, and let's base this on the previous example we've had. But let's work with a really simplified situation. Let's assume we've just bought the asset for $100, so its carrying amount and its tax base are 100, and as soon as we buy it, we revalue it. I didn't say this was going to be realistic, right? So if we revalue the asset up by $50 to 150, we revalue for accounting, so our carrying amount becomes 150. Tax base, of course, is unaffected. Now, what are the implications of that for depreciation? Well, your depreciation in the next few years is not going to be 20, 20, 20, 20, 20. It's going to be 30, 30, 30, 30, 30. So from year 0 to year 1, there's $30 of depreciation. There's another 30. There's another 30. But for tax, again, let's assume it's going to be still over 5 years, it's going to be 20. They still get to the same place. So is there a difference between the 150 and 100? Is it a temporary difference? Yes, it is a temporary difference. It's going to go away. By the time you've got to year 5, it's down to 0. Problem is, how do you know there's a temporary difference? When you did the revaluation, did that revaluation affect profit? No. Your revaluation debited asset and credited revaluation surplus. So if you looked at accounting profit and compared it to tax profit in the first year, you wouldn't know there's a DTL, because the accounting profit and the tax profit would still be the same. So, okay, the balance sheet tells you, hey guys, look, I've got a DTL, because the carrying amount is different than the tax base. But profit won't tell you about that, because none of this affects the income statement or the tax return. So, what do you do? Well, we know that we've got that temporary difference. We compare carrying amount to tax base. There's a temporary difference of 50, and obviously, therefore, the DTL is going to be 30% of that 50 at a 30% tax rate, so that's 15. But we can't use the usual deferred entry to pick that up, because none of this information appears in any of the profit calculations. So the way we pick up the deferred tax liability has to be in the revaluation entry by itself. And if you look at this revaluation entry, there's actually a pretty sensible way of understanding it. Yes, the asset's gone up by 50. But why do you revalue an asset up by 50? Because it's got $50 more benefits. Well, those benefits will be received at some stage in future. And when those benefits are received, we're going to get some of them, but the taxman's going to get his share because we're taxed. So if we're saying that the value of the asset has gone up by 50, here's the 50 revaluation, but we get some of it, 35 to other comprehensive income, to owner's equity, free revaluation surplus. The rest goes to the deferred tax liability. Now, of course, the taxman doesn't know about this up front, and he doesn't need to know about it. But when we come to selling the asset or using it, we will see that the depreciation is different or the gain on sale is different. Okay, so this is how we pick up the tax effect of a revaluation. Obviously, if you had a revaluation downwards that affected revaluation surplus, it would be a reduction in deferred tax liability. If you have a revaluation that affects the income statement, like a loss on revaluation or a reversal, that's all right. They get picked up automatically because they appear in profit. Let's talk about disposal of an asset. How do DTAs and DTLs, deferred tax assets and deferred tax liabilities, reverse? Well, they reverse because they have a different effect on accounting, because the item that causes them has a different effect on accounting profit than on tax profit. Now, that can be through depreciation or it can be through a sale. So future depreciation is going to be different. What if you sell it before it's fully depreciated? If the carrying amount and the tax base are different because of the different depreciation, then the loss that you calculate for accounting is going to be different than the loss you calculate for tax. So, are we expensing the asset? Yeah, when you calculate a gain or loss on sale, the gain or loss really consists of two things behind the scenes. A gain exists because you've got a revenue. In other words, you're receiving an amount bigger than what you're giving up. Now, we don't call it a revenue, we don't call it an expense, we mix them up in gain. But behind the scenes, that's what's happening. The asset's going out and proceeds are coming in. The asset going out for accounting will be the carrying amount. The asset going out for tax purposes will be the tax base. If they're different, then the gain or loss on sale will, of course, also be different. So let's go back to the example we've just been working with, and let's revalue that asset up in year 0. So here it is being revalued up in year 0, and then let's depreciate it. Okay, so we know we've got a DTL of 15. The difference between 150 and 100 gives you a taxable temporary difference of 50. The tax effect of that multiplied by the tax rate gives you 15. If we come up to year 1, we depreciate it. There's $20 depreciation here, 30 here. So the carrying amount and tax base are getting closer. The DTL is getting smaller. It's now 30% of 40. It gives you 12. So some of it has reversed. We get to the second year, 30 more depreciation here, 20 more here. So some more of that difference has gone away. Now the temporary difference is the difference between 90 and 60, multiplied by 30%. That gives you the DTL. The DTL balance at the end of the second year has to be 9. Okay, now what happens if you sell that asset at the end of year 2? So you get to the end of year 2, you sell it, and let's say we're selling it for $200. What's the accounting journal entry going to be? Well, we're receiving $200. That's going to be the same for accounting and for tax. We are getting rid of the asset. Now remember, the asset for accounting was revalued to 150, so we're getting rid of an asset of 150. And the accumulated depreciation is based on the revalued amount. So by the end of year 2, the accumulated depreciation is 60. So we're getting rid of that. Over in tax measurement, the asset was still recorded as the original amount, and the accumulated depreciation, well, it's been going down by 20 each year, so it's gone from 100 to 60. The accumulated depreciation is 40. So we need to get rid of that. So we're receiving cash of 200. We're getting rid of an asset that's recorded at carrying amount of 90. So our gain for accounting is 110. What about for tax? We're getting cash of 200. We're getting rid of an asset that has a tax base of 60. So we've got a gain of 140. Okay, so we've got a gain for accounting that's different than a gain for tax. Now, gain on the sale of the asset goes into accounting profit. Gain on the sale of asset goes into tax profit. So our accounting profit is going to include this. Our tax profit is going to include this. So our accounting profit is less than our tax profit by 30. So the last temporary difference goes away. That's the 30. If you multiply by 30%, that's taking away the remaining $9 of the DTL. So it does actually reverse when you get rid of an asset. Okay, so you know what? It doesn't actually matter how you get rid of the asset. You can get rid of the asset by using it or by selling it. The DTA or the DTL will reverse. And that makes sense because once the asset's gone, both the carrying amount and the tax base are 0. Just a comment about the applicability of relevant accounting standards. This presentation reflects international financial reporting standards and international accounting standards as reflected in Australian standards, which are a direct copy, as at the 22nd of October 2014.